Now that we have a firm understanding of the legacy payment systems in the US, it's time to explore some of the more exciting fintech payment developments, starting with mobile payments. We'll begin by looking at how the use of mobile payments has grown in the US over the last few years, before we examine their benefits and risk. We'll conclude by taking a look at how mobile payments fit into the existing payments legal framework. With the launch of so many alternative payment instruments since the financial crisis, consumers now enjoy unprecedented options when it comes to paying for goods and services. These include tools that allow customers to pay in-store with their mobile phones, make payments via social media, and send instant person-to-person transfers between bank accounts or debit cards. While these tools enhance customer convenience, they also produce new risk. Many of these new payment tools work as an app on our smartphones, and they are often linked to our existing debit or credit card and are processed through the networks and channels for these types of payments. In some cases, fintech providers may also route their payments through the automated clearinghouse networks, which, as we discussed in the last lecture, have traditionally been used to facilitate automatic bill payments or funds transfers between banks. Fintech payments can also be made by charging a consumer's mobile phone bill. Perhaps you have donated money to the Red Cross or some other charity through text message, which ultimately showed up in your phone bill. Before we get into the details of these various payment methods, let's take a look at how the use of mobile payments has grown the past few years. Here we can see that in 2015, 24% of respondents in a Federal Reserve survey reported using mobile payments within the past 12 months, which is double the amount who reported using mobile payments in 2011. Unsurprisingly, use of mobile payments is most prevalent amongst younger consumers, with 32% of respondents ages 30 to 44 and 30% of respondents ages 18 to 29 reporting using mobile payments within the past 12 months. Amongst those who use their smartphones to make mobile payments, the most common reason is to pay a bill, with 65% of respondents indicating they've done this within the past 12 months. The next most frequent use of mobile payments, at 42%, is purchasing a physical item remotely. Interestingly, only 33% of mobile payments users have actually used their mobile phone to pay for something in a store. The most common form of mobile payment is made through what's known as a mobile wallet, which is simply an electronic version of a consumer wallet that offers consumers the convenience of faster transactions without having to enter credit or debit card information for each transaction. Mobile wallets replace sensitive information with randomly generated numbers through a process called tokenization that provides greater security when making a payment, and then transmit this information using existing credit and debit card networks. Consumers may use mobile wallets to make payments to other consumers, referred to as person-to-person, or P2P payments, or to businesses, referred to as person-to-business, or P2B payments, either in mobile applications, through mobile browsers, or in person at a store's point-of-sale terminal. A variety of companies provide mobile wallets, including Apple, Google, PayPal, Square, and Samsung, merchants such as Starbucks, Walmart, and CVS, and financial institutions such as JPMorgan Chase and Citibank. Here, we can see how frequently some of the more popular mobile wallets are used by consumers. In March of 2018, 64% of survey respondents reported they had used Venmo, which is owned by PayPal, within the past 12 months, which is up from 61% the year before. We can see that the other mobile wallets, run by tech heavyweights, come nowhere close to Venmo in terms of popularity. One new entrant who has successfully challenged Venmo's market dominance is Zelle, which launched in 2017. Zelle is owned by a consortium of 7 of the country's largest banks and is currently being used by close to 20 banks, with 70 more in the process of signing up. Given the number of banks that have integrated Zelle into their mobile app, Zelle now connects approximately half of all checking accounts in the U.S. In 2017, $75 billion passed through Zelle's network, more than double the amount that passed through Venmo. Zelle's early success is another reminder that traditional financial institutions are also constantly innovating and are not just going to sit back while new fintech firms take their market share. All of these mobile wallets offer consumers the convenience of instant transactions without having to enter credit card information, PIN numbers, and shipping addresses each time they make a purchase. Mobile wallets also streamline the checkout time, as now consumers can pay for goods by simply waving their smartphone in front of a terminal and be on their way. Mobile wallets also improve data security by replacing a consumer's payment card information with a randomly generated number or token. Of course, one of the risks associated with mobile wallets is that consumers could lose their phone or have it stolen. Provided the thief was able to unlock the phone, they would be free to make payments using the mobile wallet. There is also potential for human error. For example, a consumer could accidentally send money to the wrong person if they type in the wrong phone number. There is no one law or government agency that oversees mobile payments. Since most of these mobile payment technologies run on legacy payment systems, such as credit and debit cards and ACH, the laws and regulations applicable to legacy payment systems will apply to new mobile payments. For instance, Venmo uses ACH processing to fund their customers' peer-to-peer payments. Therefore, the laws and regulations applicable to ACH transactions apply to Venmo transactions. Determining all of the laws that apply to mobile payments depends on several factors, including agency jurisdiction, the mobile payment provider's relationship to depository institutions, and the type of account used by a consumer to make a mobile payment. If a mobile payment provider is partnering with a depository institution, federal banking regulators are authorized to examine and regulate the mobile payment provider and the service it is offering. Recall from our discussion on regulating cryptocurrency as money that states have licensing and regulatory authority over businesses that provide money transfer services or payment instruments, and this can include mobile payment providers. So fintech firms such as PayPal and Google Pay are subject to state money transmitter laws. You'll also recall from our cryptocurrency conversation that all firms that transmit money, whether they use traditional or fintech products, are subject to federal anti-money laundering laws. Non-bank mobile payment providers may also be subject to Consumer Financial Protection Bureau and Federal Trade Commission Consumer Protection Enforcement actions, as these two agencies share joint enforcement jurisdiction over certain non-bank providers of financial products and services. In fact, the FTC has brought and settled enforcement actions alleging unfair or deceptive conduct by several wireless providers of mobile payment services. In addition, any mobile payment product that includes wireless bill charges as a payment method may be subject to the Federal Communications Commission authority, as they have jurisdiction over wireless providers. Finally, consumer protection laws, such as the Electronic Fund Transfer Act, which apply to traditional funding sources, do not yet cover payments funded by mobile wallet balances or mobile carrier billing. To address this gap, in October 2016, the CFPB issued a final rule to add prepaid cards and some of the payment services that fintech providers are offering, such as PayPal, to the definition of accounts covered under regulations applicable to electronic fund transfer systems, such as automated teller machine transfers, telephone bill payment services, point-of-sale terminal transfers in stores, and pre-authorized transfers from or to a consumer's account, such as direct deposit and Social Security payments. The rule would extend protections for error resolution and liability for unauthorized transfers to prepaid account and mobile wallet balances, but the effective date of the rule has been postponed to April 1, 2019.